All right, let's dive right into this explainer. Today, we're zeroing in on one of the most fascinating corporate turning points in recent memory. It's August 2026, and energy giant BP, well, they're standing squarely at a historic crossroads. On the one hand, they've just posted their highest profits in over 4 years. But on the other, management is executing a massive, absolutely ruthless corporate pivot that is completely shaping the company's DNA. It's a true paradox, right? Blockbuster numbers colliding with a radical restructuring, and we're going to break down exactly what this all means for you. To really grasp the scale of what's happening here, you just have to look at this number, $5.73 billion. That was BP's underlying replacement cost profit for just the second quarter of 2026. Guys, this isn't just a good quarter, it is a spectacular win. To put that into perspective, their earnings per share came in at $2.22. That represents a staggering 47% beat on consensus estimates. I mean, it is an absolute windfall. So, here is our roadmap for today. First, the blockbuster quarter. Second, a strategic overhaul. Third, market sentiment. Fourth, risks and challenges. And finally, number 5, the bull versus bear case. Section 1. The blockbuster quarter. Behind the $5.73 billion win. The sheer scale of this year-over-year leap is just incredible to look at. When you compare Q2 of 2025, which sat at $2.35 billion, to this quarter's $5.73 billion, you can see that profits have literally more than doubled. This absolutely blew past Bloomberg's consensus estimate, which was sitting at $5.01 billion. So what exactly drove this massive earnings beat? Well, it boils down to 3 distinct factors. First up, geopolitics. The escalating U.S.-Iran war has tightened global energy supplies significantly. That pushed Brent crude up to $94 a barrel, which, as you know, if you've been filling up your gas tank lately, creates a massive ripple effect right down to the consumer level. Second, BP's integrated model just completely thrived. They saw booming refining and trading margins by capturing value across their entire operational chain. And third, all of this translated into a phenomenal $10.9 billion in operating cash flow. That gives them some massive financial firepower to reward shareholders, including a very nice 4% bump to their quarterly dividend.
But hold on, because here is where the story gets a little complicated. The crucial point here is that despite this huge financial windfall, there are some severe operational cracks showing beneath the surface. Upstream production actually fell 6% sequentially, and refining throughput declined 4%, mostly due to maintenance and operational disruptions. And honestly, more alarmingly, their safety performance missed expectations. This was tragically highlighted by a fatal incident at Castrol's Gemlik blending plant in Turkey. Because of these underlying fundamental issues, BP actually had to go ahead and cut its full-year production outlook.
Okay, moving on to Section 2, a strategic overhaul, Meg O'Neill's new direction.
New CEO Meg O'Neill used the Q2 earnings call to deliver a remarkably blunt diagnosis. I mean, just listen to this. We are not making the most of our potential. Our performance over the past few years has not met expectations. Really think about the tension there. You have a company doubling its profits year over year, yet its brand new leader is openly and very firmly admitting a total failure to meet fundamental operational expectations over the last few years.
So how do you fix that? Well, O'Neill unveiled a rapid-fire 5-priority turnaround plan. 1. Strengthen the balance sheet by reducing financial obligations. 2. Aggressively simplify the portfolio. 3. Tighten investment discipline, meaning concentrating capital only where it delivers strong cash flow through the whole cycle. 4. Improve operations and fix those slipping safety standards. And 5. Hardwire accountability by restructuring into just 2 main segments, upstream and downstream. Now, notice what's conspicuously missing here? Yeah, there's a definitive pivot away from their previous focus on low-carbon transitions. They are moving firmly back toward their core oil and gas roots.
Let's see how this translates into concrete action. To simplify the portfolio, BP is ruthlessly cutting assets that just don't generate strong returns. Look at this list. Archaea Energy, the U.S. biogas business they literally just bought for $4.1 billion in 2022, is already on the chopping block. Talk about major corporate buyer's remorse, right? They're also launching a sale for their North Sea business. The Gelsenkirchen refinery sale, already complete. The Austrian retail operation sale, agreed upon. And they've completely exited Bay du Nord. In total, they're targeting $8 to $9 billion in divestment proceeds this year alone, all to hit a net debt target of $14 to $18 billion way ahead of schedule.
And O'Neill made another fascinating demand on that call. She actually wants the market to stop calling BP a super major. Instead of endlessly trying to match their larger rivals, she says BP needs to compete in its own weight class. Guys, this is a definitive, monumental shift in corporate identity. The whole expanse of renewables era, at least as the market previously envisioned it for BP, is officially over. They are getting smaller, leaner, and fiercely focused on fossil fuels.
Which brings us to Section 3, Market Sentiment, Wall Street's Reaction. Simply put, investors have been absolutely loving it. BP's London-listed shares are up an incredible 26.10% year-to-date, hitting fresh 8-week highs this August. In fact, if you look at just the past month alone, the stock jumped nearly 19%. They are really riding both the massive earnings beat and the broader rally we're seeing in global oil prices.
But take a second and look at this analyst table. We've got Evercore holding at $52, Wells Fargo at $48, Freedom Capital down at $43, all the way down to Bank of America maintaining a sell rating with a target of just $37. So what we're seeing here is an extremely wide dispersion of price targets across Wall Street. It beautifully reflects the massive disagreement among market experts regarding BP's actual valuation and, honestly, the realistic prospects of O'Neill's aggressive turnaround.
A big reason for this split opinion is valuation. BP is currently trading at a price-to-earnings ratio of 21.4 times earnings. Compare that to the broader oil and gas industry average, which sits way down at 13.4 times. What does that mean for you? Well, it means the market is already paying a massive premium for BP's stock. The easy, cheap valuation case is completely off the table at this point. Investors are largely already pricing in a totally successful execution of this turnaround strategy.
Moving right along to Section 4, Risks and Challenges, the roadblocks ahead. All right, there are 6 major risks threatening this new strategy. First and foremost, oil price volatility. This entire debt reduction plan relies heavily on oil staying expensive. If geopolitical tensions ease up and Brent drops below $70, well, deleveraging stalls out. Second, executing a restructuring of this massive magnitude is just incredibly complex. Third, as O'Neill herself admitted, their operational reliability and safety have been slipping, which risks major production outages. Fourth, there is a serious governance overhang. Let's not forget that just months ago, in May 2026, the board unanimously ousted Chairman Albert Manifold over conduct concerns. That kind of boardroom drama creates real, lingering uncertainty. Fifth, they're banking on billions in divestments, but what if they can't get good valuations for those assets? And finally, the long-term energy transition risk. By abandoning their renewables push to double down on oil, they are highly exposed as the global economy slowly shifts away from fossil fuels.
And that leads us to our final section, Section 5, the bull versus bear case, weighing the future.
Let's weigh this out. If you're looking at the bull case, BP offers a highly attractive 4.5% dividend yield and a very credible, accelerated path to debt reduction, all under a no-nonsense CEO who clearly isn't afraid to cut the dead weight. But if you look at the bear case, you see massive execution risk. You've got a company with slipping operational safety standards, attempting a very complex structural pivot, all while relying on completely unpredictable global oil prices to fund the whole shebang. Which leaves us with this final, essential question. Can BP successfully execute this ruthless return to its oil and gas roots? Or is this pivot a dangerously risky step backward for a company operating in a rapidly transitioning global energy market? The numbers from this quarter are definitely spectacular. But the true test of Meg O'Neill's strategy, it's only just beginning. Keep a close eye on their debt reduction and operational safety over the coming quarters. Thank you so much for joining me for this explainer. Keep learning, keep questioning, and I'll see you next time.